What is the history of reserve requirement changes? Have you ever wondered how banks decide how much money they can lend? One key factor is something called reserve requirements. Let's take a closer look at the history of these requirements and how they have shaped monetary policy over time. Reserve requirements are rules that tell banks how much money they must keep on hand compared to the deposits they hold. This concept started in the early 19th century. After the Panic of 1837, states began to set minimum liquidity ratios for banks. These rules aimed to ensure banks had enough cash to meet customer withdrawal demands. However, even with these rules, banking panics still happened, showing that reserve requirements alone could not guarantee stability. In 1863, the National Bank Act established formal reserve requirements at the national level. This act required nationally chartered banks to hold reserves against their deposits. The goal was to boost bank liquidity and stability, helping banks convert deposits into cash when needed. The creation of the Federal Reserve System in 1913 changed the role of reserve requirements. They became a tool for monetary policy, helping to control credit availability and the money supply. In 1935, the Federal Reserve introduced variable reserve requirements, allowing adjustments based on economic conditions. This was a notable advancement in managing the economy. Throughout the 20th century, reserve requirements changed in response to various economic events. For instance, during the late 1930s, requirements were raised to reduce excess liquidity. In World War II, they were lowered to help banks manage war loans. The 1950s and 1960s saw a gradual decrease in reserve requirements, as concerns grew that they were too restrictive. However, modest increases occurred in the late 1960s to cool off an overheating economy. Reserve requirements serve multiple purposes. They help ensure banks have enough liquidity, influence lending conditions, and act as a tool for monetary control. However, their effectiveness has varied over time. The Federal Reserve has relied less on reserve requirements as a primary monetary policy tool. Other methods, like interest on reserves and open market operations, have become more prominent. In simple terms, reserve requirements impact how much money banks can lend. Higher reserve ratios mean banks must hold more funds in reserve, leading to less lending and tighter credit. Lower ratios allow banks to lend more, potentially boosting economic activity. The history of reserve requirement changes shows how financial regulation adapts to meet the needs of a changing economy. It highlights the balance between maintaining stability and encouraging growth in the banking system. Understanding this history gives us a clearer picture of how monetary policy has evolved over the years.